All right, let's talk about Solana DeFi. Just to kick off with who's who, I'll start. My name's Mark, and I'm from Kamino. And although I'm English, I don't live here, unfortunately, but it's great to come over to London. I'm based in Switzerland. And Kamino is Solana's largest DeFi protocol. The two main things we do are basically on-chain market-making strategies, and the biggest is a credit marketplace. So we do borrowing and lending. We've built smart contracts, and in essence, we're serving two main parties. One is borrowers are able to come in and collateralize their crypto assets and take loans. And on the other side, we provide utility for lenders. So the big case there is with stable coins, they can come to Kamino and earn yield. Kamino's quite young. We launched Kamino Lend in 2023, October, November. That grew from nothing in less than 2 years. We have over $3 billion worth of assets on the platform. Currently, there's open loans of over $1.1 billion, and and Kamino's thriving, helped by the fact that Solana's been thriving the last couple of years. We've seen a massive increase in the economic activity on chain on Solana, and a bunch of super interesting tokens as well. And small anecdote. I was just thinking back to the last Solana event I came to in London, and it was in 2022, a hacker house. And I think Joseph was talking about the profile of people in the ecosystem. That was very much a builder-centric session. There was no suits there. And I just realized we first started working on Kamino in London Hacker House, so back to where it started. Anyway, I'll move on now because we've got some great colleagues and partners. All of you guys we work with at Kamino, but doing different things. So I just want to kick off really for each of you to say what you do, what your company does, and what the angle is with regards to Solana DeFi. Thanks.
I can start. My name is Yannick, leading special projects at Bitwise On-Chain Solutions. That currently means vaults, especially vault curation. Bitwise recently announced that we're coming on-chain as sort of the first fully regulated asset manager going into DeFi curation. Solana obviously being very important on that front. I have to caveat that by saying that I was with Chorus One until 3 weeks ago, where we got bought up by Bitwise. So this is all fairly fresh. If you want to know more about Bitwise on the ETF and ETP side, I think Bradley is still here, so I would encourage you to talk to him. But yeah, I think the way that we're seeing DeFi evolve, we see a lot of interest in yield generated on-chain from more regulated financial institutions, and that's where we think Bitwise comes in and is a great counterparty to these asset allocators. As I said, we're regulated. We can offer these services through our regulated entity, and I think that offers some advantages. But yeah, I think we can get into this more later.
Thanks.
My name is Nadareski. I'm the founder and CEO of Solstice. And what Solstice does is we issue a stablecoin on Solana, which is about the 5th largest stablecoin on Solana currently. We also are alpha generators. We have a tokenized yield solution with a delta neutral strategy that we set up really with one purpose. Institutional allocators wanted to come into the DeFi sector, but they needed safe vehicles to do so. They needed also vehicles that could scale. And that's exactly what we set up at Solstice, launching the fund and the protocol permissionlessly in September 2025 and scaled up to just over 360 million as of the last week. So despite spot markets, we're seeing all-time highs on the Solstice side, which is another testimony to the Solana ecosystem. And I think from everybody on stage, we're working with just about everybody here except for Bitwise, so we got to get something going soon. But we're very happy to engage with the broader Solana community tonight.
Hi everyone, David Vatchev, Head of Tokenization at Fasanara Capital. So Fasanara is an alternative asset manager focused on real-world assets. And how we generate yield is with asset-backed lending. So things like invoices, receivables, importantly not multi-year loans to over-leveraged software companies, which is making all the headlines these days. So that's one segment of private credit, but we very much focus on the short duration end, and we make sure the collateral is there as well. And quite uniquely, we also have an in-house digital asset management fund in Fasanara Digital. So we've been going there since 2018, been running market neutral, delta neutral crypto strategies. So as my role, I sit at the intersection of that, the intersection of RWAs and DeFi. And what we've really been trying to do is what is it within RWAs that DeFi effectively lacks and needs to basically expand that ecosystem. And we've been really trying to tailor that combination of historic returns that ultimately come from uncorrelated yield, so productive economic activity in the real world, and balancing that with actual real cash flows that amortize in line with schedules with DeFi liquidity, which is the key thing, and that addresses the duration mismatch. And we've been super excited. We've launched several tokens here, which have use cases within DeFi markets for leveraged looping, which is obviously completely new and allows for fresh use cases. We've also been able to distribute through stablecoin backing for their yield, because again, most of them are either crypto-backed or money market funds or just on-chain use cases, which are ultimately correlated. And then the final most interesting one is actually just treasury management, where just the on-chain market is starved of yield and just needs something which will give them diversification. Now, what's super interesting is most of our activity so far has been on Ethereum, but we're very proud to be launching on Solana and on Kamino very soon. And it's great testament to the work that Mark and the Kamino team have been doing. And of course, honor and a pleasure to work with Steakhouse as well and help in that process.
And hi, sorry. My name is Adrian. I'm a co-founder at Steakhouse Financial. We're a vault curator, the leader in the space. We have $4 billion in non-custodial deposits under management across different platforms, 2 billion of which in sort of vault products, and I think slightly under 100 million on Solana. And our focus is very much on bringing a sort of traditional bank management or traditional finance perspective to DeFi. And most of our focus tends to be around stablecoins. 90% of our volume is stablecoin backed. And we mostly work with institutional partners, exchanges, players like Coinbase or asset managers like Fasanara, where, obviously trying to, the biggest challenge is marrying the duration aspect of credit with the demand for liquidity and volatility in DeFi.
Thanks, everyone. And a great selection of different types of activity that's happening in Solana DeFi. It kind of feels like we've gone from 0 to 1 in DeFi overall, and kind of the same with the institutional angle, right? So the 0 was building smart contracts, thinking about oracles, security, crypto native assets. We had Sol being, of course, the big one. We had this random stuff like the meme coin wave and very crypto stuff. And now we're going into this, as I said, like 0 to 1 phase of especially institutional DeFi. We've got interesting assets coming on chain, like tokenized real-world assets, tokenized funds. We're also, I think at Kamino as well, we're very product-led in our thinking of development as well. So we're trying to meet traditional finance, meet institutions with the types of things that they need, like fixed rate borrowing and so on. But it still feels like it is that one. We're not yet where we need to be. So we're building products, we've got interesting assets. We've done a lot with this modularity, which has allowed Kamino to introduce lending vaults. So that has the likes of Steakhouse and Bitwise coming on board as collaborators in Solana DeFi. But it still feels like there's some structural barriers to even greater participation, especially at scale from institutions. So what do you think the key barrier is, or barriers? And then what can we build and what are we building to try and break that down? Who wants to go first? It looks like
I'll lift the
Ben's
mic. I
nodding,
think I'm
so-
committed now. So from an institutional allocator perspective, we have, as mentioned, about 60 to 70% of our allocations are from institutions working with global investors that are looking, how do I get my capital into the DeFi ecosystem safely? And when they look at these protocols initially, and this is only probably after the last 2 years of development, none of them can take the smart contract risk because you can't put that directly into court. You can't bring that into a legal battle. You can't have that in part of the regulatory environment. From their shareholders, from their equity capital investors, whatever it might be, the mandate is very clear. So setting up the proper structure with institutional grade qualified custodians, with regulatory reporting, full audits, attestations of reserves, these type of dynamics are just now coming to fruition as a full package that allows for these institutions to safely allocate. And we're just now getting to that cusp of a breakthrough where enough institutional allocators are over the line that the majority and the bulk are going to start to see the early innovators in that sector say, where are you guys allocating capital? It's into DeFi. How are you guys doing that safely? And what that means safely is, for example, at Solstice, we have a managed, licensed, regulated fund that is invested into from institutional allocators for full KYC and AML compliance. The most important part of that dynamic is institutional allocators can come in, but the protocol and the tokens involved are fully permissionless for the general DeFi community as well. So that preserves both sides at the same time, allowing for the protocol to come to fruition.
Yeah, I mean, I fully echo that. As an FCA-regulated asset manager, we're not going to be able to take a smart contract to court on legal recourse or so. So ultimately, on-chain infrastructure was built for crypto natives and not for institutions, but things are changing. And Ben made some great points there on the risk element. There's been a few comments on some panels about the UI, which I think is again very true. If anyone's tried to interact with this, certainly before, it's obviously very difficult versus a centralized platform. But another thing I would say is also the return side and actually the efficiency of capital. So TradFi is really built around rate markets and prime brokerage. So it's very difficult to allocate to something where there's 60, 70% utilization. So actually the inefficiency of capital is also a big barrier for that. But again, that's being addressed, and the curated vaults and isolation of risk, a lot more audited fixed borrowing rates, which is obviously part of Kamino, as well as tri-party custody. These are the kind of things that are moving the industry forward.
What do you think?
And generally the two main ways that you can increase yield, let's say from a traditional finance perspective, are increasing duration or increasing volatility. And typically a traditional participant would tend to prefer something like increasing duration, which makes sense, but crypto is built on volatility. So if you can't parse that, or if you can't translate those crypto primitives for an audience that expects duration, it's going to be very difficult to marry the two. And I think the instant rates, fast-moving DeFi markets have their use case, and the composability and the instantaneous nature of them have a very strong value proposition. But the reality is that it needs to allow for longer. So crypto natives need to start to get used to more duration, more lockups, more illiquidity, and time in place for the capital to really mature. In our view, institutional allocators to be able to get comfortable to use it. And then the other thing is, I think you touched on something that we call the difference between a social guarantee and a crypto guarantee. So something like a legal system or legal recourse is something that's necessary in traditional finance as a way of providing investors the security that they have some recourse over their assets eventually. And crypto's benefit, let's say, is that the social guarantee can be encoded, can be written down in the rules, encoded and enforced in the same transaction. That's our view of what the real unique value proposition of crypto vault is relative to, say, an ETF. But even if you wrap a crypto product with all of its strong cryptographic guarantees in a quote-unquote social guarantee product, there's still so many hurdles to overcome to be able to fully understand and parse what that means. And frankly, if the cryptographic guarantees aren't strong enough and you only rely on the social guarantees, you're probably better off using a traditional brokerage and buying an ETF. So I think that the vaults really need to step up the game on the cryptographic guarantee side of things in order to demonstrate an actual value proposition.
Yeah, I think two things I would add is one, I think one thing we're still trying to figure out is compliance on permissionless markets, right? I think, we've seen a lot of interest in tapping into these markets for liquidity reasons and yield. But then given that these contracts are immutable in many cases and fully permissionless, how do you guarantee that you don't touch any illicit funds? So I think that's one thing where we're still need to do some work where we preserve the permissionlessness of the markets, but still make institutional allocators comfortable with, or give them some sort of guarantees that once a certain threshold is reached, maybe that the product gets gated or money gets pulled out. And then I think the other one is access. I think what you guys did with Anchorage and Solana Company, being able to borrow against assets that stay in qualified custody. I think that's super interesting. I think more of these type of products are needed. May that also be something like wrapping a vault into sort of an ETF type product, and then have users have allocators be able to access this where they currently live. I think there's also still a lot of room there where we can work on together to bring more money on chain.
Sounds good. Thanks for the insights. And actually, yeah, I agree there. I think there's room for traditional products that enable the opportunity in DeFi to be brought into traditional finance, but then vice versa, we see some really good advantages and opportunities of being on chain, right? We've got opportunities where yields are great, where what would be a liquid investment can be tokenized and made liquid and be given utility in DeFi, whether it's about leveraging it, boosting the yield profile, and so on and so on. So that it feels like the DeFi innovation is just getting going to tap into the opportunities that the wave of tokenization is bringing. And that kind of brings me, because I'm pretty optimistic. As I said, we're at 0 to 1, and I'm very excited about new products coming, new tokens coming, partnerships that are being forged, both with new players in crypto and traditional players entering more DeFi. What are you guys bullish on for the next 12 months? Let's just go. I'll start down there, Adrian, and come
So,
up the line.
one of the things that we've been impressed the most, so most of our time and attention until now has been on Ethereum, where there's a lot of DeFi activity, and there's a lot of things that are really useful learnings there in bringing to Solana. And one of the things that we've been uniquely impressed about the Kamino team is their ability to create novel opportunities themselves, go out, sweat it, put the work in to create, just like the Anchorage thing, for example. The Prime market from Figure is another illustration of a really brilliant on-chain capital formation opportunity where DeFi is sort of a unique venue for bringing capital together and raising it. This is something that we did, the early innings of on Ethereum with Fasanara, and we hope to replicate on Solana as well. So frankly, more of this unique on-chain capital formation, I think, is one of the key things. It's good to bring, the big money bags onto DeFi, but I think DeFi has a really unique opportunity to be a capital formation platform in its own right. And, Kamino is, frankly, a great place to do it.
Yeah, and I'd echo and even build on that. So Adrian and I were talking vaults long before they were a thing in the spring of last year. But I think what's more interesting is actually what what the good people at Bitwise are doing right now, which is not just the vaults and RWA liquidations and the likes that are just sort of hot themes, but it's really this evolution to full on-chain asset management. So how many TradFi asset managers actually have DeFi fluency or on-chain fluency? How many of them will be able to set the parameters of the vault? How many will be able to credit underwrite the actual assets in there and be able to find sources of yield for these idle stable coins and leverage blockchain in order to move the capital? I think really that evolution is going to be game changing.
In the next 12 months, I think one of the major pieces here is you can tokenize anything, you can bring everything on chain, but where is the value proposition? And one of the major value propositions that we see is the aggregation of the vertical stack, for example, of Solana coming together. So a great example was between Kamino, Solstice, Fasanara, Exponent, that intersystem loop between max cash optimization when you deploy across the DeFi stack. We're just now starting to get all these nodes and all these puzzle pieces plugged in together. And that has pretty much occurred in the Solana ecosystem more rapidly in the last 6 to 12 months more than ever. And by the next 6 to 12 months, we're going to see a wider ecosystem of that vertical stack playing as one value proposition. You enter in once, you get max cash optimization across these different applications, and that education gap continues to close between mass retail entering. So it's how all these protocols work together that we're going to really start to see it come to fruition.
I think for me it's two things. One, we work with a lot of the large banks, and I think every single one of them is looking at this, which I think is exciting. So we'll see what happens there this year. And then personally, I'm quite excited about sort of yield and float economies, PayFi, remittances, these type of things where, or even, kind of salaries and similar things where there's always a certain float of stable coins or generally money sitting somewhere. And in some cases, it may already earn, sort of T-bill rates. But with instant liquidity and DeFi rails, I think there's a lot of very interesting things that you can do. And so that's an area where I'm personally quite excited about for this year, and where I think Solana specifically is fantastically positioned and capturing a lot of that market, and us being fantastically positioned to build a lot of yield around that. So that's for me, from my side.
Yep, awesome. So thanks for the partnership, thanks for the great discussion, and let's get back to it.
Thank you.